So thank you for giving up some of your lunchtime to hopefully learn a bit more about the basics of business finance, which, as I mentioned a moment ago, might not be everybody's favorite way to spend a lunchtime, but delighted you're able to join. I'm going to start by saying a little bit about me and then covering off some basic concepts around understanding financial statements. Before I introduce myself, though, we are going to be using a software tool called Vivox. And if you hold your phones to the screen, let me do this in a way that makes that QR code a bit easier. So let me share my screen again. If I can ask you, please, to hold your smartphone cameras to the screen and activate that QR code. It should take you into a software tool called Vivox. And we use Vivox to make these sessions as interactive as possible. So I've got a series of activities, multiple choice questions and so on, which hopefully allow you to join in, share your understanding, and hopefully make it even more fun than it would be otherwise. So you either join by using the QR code, or if I pop in the chat, there is a link. So another way of joining in, an alternative way, would be to simply click on the link and it opens up a new web browser on your device, hopefully. And that's another way to join in. So perhaps while we're in Vivox, maybe it makes sense actually for me to launch the very
interactive thing. So here is what we have to join to do the interactive, but I don't have QR codes on my phone.
Oh, don't worry. So if you're, sorry, someone's speaking there, I could hear you. If you don't have a QR code on your phone, don't worry. In the chat, I've just posted a link. If you click on the link, you'll be able to open up Vivox on your device by opening up a new web browser. So it's not essential that you join on your smartphone. Don't worry about that. You can join in however you would like to. And if you can't join Vivox, don't worry, you can still answer the questions, even if you can't do so in Vivox. So let me just, in the spirit of sort of demonstrating how this tool works. So as a way for me to find out a bit more about you all, please bear in mind this is anonymous, but it would be really great to know what your current confidence is with the subject of accounting and finance on a scale of 1, a beginner, to 5, an expert. So for anyone who can't join in via Vivox, feel free to turn your microphone on in a few seconds and just tell me what your score is. But I can see most of you have joined in. We've got 11 active participants and 7 of you have voted. So maybe just a couple more seconds to give you a chance to vote, just so you get used to how this tool works. 3, 2, 1, last chance to vote. Okay, let's see where you're starting from. Okay, wonderful to have one of you who believes you're at a 4, which is great. Great to have that confidence. But obviously this session is more designed for those of you at the other end of the scale. So the idea is we're going to cover off some basic ideas, in particular on how we might understand and start to interpret financial information, financial statements. So hopefully you now have a better idea of how Vivox works. We'll be turning to it from time to time, but for most of the session, I've got some PowerPoint slides, which we will share at the end, which hopefully provides some structure to the session. So here's a little bit about me. I'm a chartered accountant. I'm actually married to a chartered accountant, and we have 2 children. And this is being recorded, but they'll never see this, will they? Because what I normally say is the children have turned out to be a great disappointment to my wife and I, because they've decided not to pursue a career in accounting. I'm only joking if Tom and Ruth do get to see this this video, which is probably unlikely. Anyway, I've spent most of my career since qualifying as a chartered accountant trying to help non-accountants understand accounting and finance. So I teach on Aston's MBA program. I'm involved in the Goldman Sachs 10,000 Small Businesses program, where I act as the UK finance faculty lead, helping entrepreneurs, owner-managers of smaller businesses, hopefully get to grips with the financial aspects of their businesses. And I'm involved in a project that led to the creation of a digital mobile game that you can play on your smartphones for free. So I hope you don't mind me advertising the Count Fifi app, and I'll say a bit more about that right at the end. But you download it, and it's a game through which hopefully you build your confidence in accounting and finance. So that's a little bit about me. Let's make a start. So I've been asked to cover off some basics of business finance. Now I'm interpreting that as business finance and accounting, and I've picked out what over the last 25, 30 years I perceive to be some of the most important financial literacy skills for managers. Understanding financial statements and terminology, being able to interpret financial statements using metrics and ratios, understanding the difference between profit and cash, and then using financial concepts and financial information for decisions, for better planning, for better control. We might call that financial management, I guess. Now, I've put two acronyms on the screen, and I invite you to join in using the chat window, which I need to call up on the screen to make sure I can see it. So I've put two abbreviations on the screen. Those in green, I've summarized as FA, and those in blue, I've summarized as MA. So to keep this interactive, what do you think those abbreviations stand for? I'll give you a clue. The A is accounting in both cases. So what do you think? You perhaps know, what is FA and MA? What do they stand for, those abbreviations? If you can use the chat and you know the answers, let me know. Feel free to guess. I can't see any answers coming in. Oh, I can. Michael, thank you very much indeed. Financial accounting and management accounting. Michael, you can now relax. I've got a follow-up question, you see, but I think Michael's done enough work for now. So Michael can relax. You're exempt from this question unless we need to bring you in. Anybody know the difference between them? So great to know that FA is financial accounting and MA is management accounting. Anybody know what the difference is between them, please? Obviously, a more important question. What's the difference between FA and MA? Any ideas? Michael, we might need your help. Feel free to join in. If it's easier to turn your microphones on, please do. There's only a small number of you, so it will work fine. Feel free to just turn your microphone on and jump in. What's the difference between FA and MA? Of course, you might be expecting me to give the answer. At the moment, I'm asking you the questions and you're waiting. Please, thank you, please. Please.
Financial is about describing current position and managerial is defining future actions.
That's very close. That's very close. The fundamental difference between financial accounting and management accounting is slightly different, though. So I'll give you this. Financial accounting is aimed at external users of that information. So stakeholders outside of the organization, maybe suppliers, the bank, shareholders, and so on, they would be interested in an organization's financial accounts. So financial accounting for external purposes, whereas management accounting is for internal purposes. So not that very different from the answer that was just shared, but I'm hoping that's clear. Can I please just assume, I'm just wondering whether you can communicate with me. I'm going to assume that you're happy with that. If you're not happy with that, come onto the microphone or put a question in the chat window, please. Otherwise, I'm going to assume that we're good to move on. So what I'd like to do for the next half an hour or so is provide you with an overview of one of these key skills, which is understanding financial statements. And there are two main statements in accounting, as you possibly know. There's something that we nowadays call the statement of financial position, which for most of my career was known as the balance sheet. So it's exactly the same thing. Accountants have a habit of having more than one way of describing things, which doesn't help, I'll be honest. So the statement of financial position, or the balance sheet, and key to understanding that statement is understanding the relationships between the three items that appear in that statement. And those three items are assets, liabilities, and equity. And we need to be careful regarding the meaning of those words in the context of finance and accounting, because they don't necessarily mean what you were expecting. The other main statement is the statement of profit or loss, sometimes called the P&L, sometimes called the income statement. And the key to understanding that statement is understanding the way in which accountants measure performance. How do we measure profits? Well, we do so by using what's known as the matching concept. We match together the income that was earned in a particular period, in the month or in the year, and we match against that income the costs that were consumed in the process of earning that income. And the name we give to costs consumed is an expense. And again, we need to be very careful regarding the meaning of words like income and expenses. They don't necessarily mean what you're expecting. Now, I'm just going to highlight there are two visual images on this screen that help us. The statement of financial position or balance sheet, you should see that as a photograph. So it sort of describes the state of the finances that the organization was in at that particular moment. Whereas the statement of profit or loss or income statement or P&L, well, that's a movie. That measures how well the business has performed during a period of time. So I hope those visuals help. So that's the overview of what we're about to focus on for the next few minutes. And I have lots of questions and activities for you to join in with. So in understanding the purpose of these two main statements, I have this diagram, which I'm going to build up for you. So I think it's important that we start with the very basics. I know at least one of you is quite confident with this subject, so this may be a refresher for you. But for those of you less familiar with finance and accounting, I think it's important that we start with the absolute fundamentals. So this diagram helps me explain the purpose of the statement of financial position or balance sheet and the purpose of the P&L or statement of profit or loss. So I want you to imagine the horizontal line on the screen with the arrowhead that represents the progress of time. And the two dotted vertical lines are therefore moments in time. And an accountant draws up the balance sheet to represent the financial position of the organization at that moment. And an organization's financial accounts will typically have two columns of numbers, numbers for the most recent year end and for the prior year end. So that's why we've got the balance sheet as at the 31st of December 2019, balance sheet as at the 31st of December 2020. These photographs. Now, I'm an accountant. I'm positive about accounting. I'm positive about balance sheets, but I think we need to be realistic. Because balance sheets are photographs, they suffer from the same limitations as photographs. They might be out of date. They may not represent the normal financial position of a business, but they may hopefully represent what the financial position was at midnight at the year end or the prior year end. So that's a bit of an overview of the balance sheet, whereas the P&L or the statement of profit or loss measures basically the changes that have occurred between the two balance sheets. So the statement of profit or loss or P&L income statement is measuring how well the business performed in generating income and in the difference between the income and the expenses. And obviously what we hope is there's more income than expenses, which means the organization has generated a profit, or we might use the word surplus if it's a charity or other not-for-profit organization. Profits or surpluses, same basic idea in accounting. So hopefully that helps. I'll pause for a few seconds in case there might be questions. And I really like Michael's comment. Indeed, just like a photograph might be photoshopped, so might a balance sheet. So there are things that organizations might do to make the picture look better at the year end than it normally is, or should be on a sort of neutral and objective basis. So I hope that's helpful. I'll pause for a few seconds in case there's questions. Indeed, Carillion being one example of an organization that used to Photoshop its accounts. In fact, at the business school, we used to run leadership development programs for Carillion, and I used to run the finance workshops. I should perhaps point out we weren't working with the very senior management team of Carillion. We were working with the middle managers and the junior managers with potential. So should explain that I don't think we are responsible for Carillion's demise. But what we learned through working with Carillion is that one of the tricks that they used to employ was to delay paying their suppliers at the year end. And that was a way of photoshopping their balance sheet. By delaying payments to their suppliers, when the balance sheet was produced, there was more cash in that balance sheet than usual. Good comment, Young. I agree with that example, that corporate example you've shared in the chat window. So there's an overview. I'm going to take us forward by focusing a little bit more on the balance sheet itself. So the first of these two statements. So the balance sheet is best understood as providing information about three packages of financial numbers. So it tells us about the organization's assets, which are essentially the resources that the organization controls. It tells us about the liabilities, which essentially are the amounts owed by the organization to other parties. And it tells us about the equity. And the equity is the owner's stake, the owner's investment in the business. And there's two ways that owners invest. They either give money to the company in return for shares, or the organization generates profits or surpluses, but they're not distributed to the owners in the form of a dividend. Therefore, those profits get reinvested, which is still part of the shareholders' investment in the company. So we've got assets, we've got liabilities and equity. And the secret to understanding a balance sheet is to understand the relationship between these three items. So assets are the resources that are controlled, but they have to have been financed. So how has the business financed its assets? Well, either through liabilities, money's owed, perhaps to the bank, perhaps to suppliers, or through the owner's investment, the equity. And all balance sheets balance because what we've got has to have been paid for somehow. So I'm going to give you an example. So I'm living in Kidderminster, not in the first house that my wife and I purchased, but back in 1991, the first house that my wife and I purchased in Kidderminster, we paid £50,000 for that house. We borrowed, because you could in those days, we borrowed £47,500, so 95% of the cost of the asset we were able to borrow from the Halifax Building Society. So hopefully a relatively simple maths question. Please join in using the chat window for this one. How much of our own equity must we have invested then? Because balance sheets have to balance. What we've got has to have been paid for. Indeed, thank you, Antoinette. Excellent. £2,500 of equity. If we couldn't raise £2,500 of equity, we wouldn't have been able to buy the house. Indeed. So what have we got? How was it financed? Well, we bought a house in Kidderminster for £50,000. How did we pay for that? We borrowed £47,500. I hope you agree that's our liability. But we also put some of our own money in, our own equity investment of £2,500. So I hope that helps. And the version of the balance sheet I've just shown you on the screen is the German version. It's very logical. It's the version that is used in many parts of the world, including Germany. I don't know whether you've noticed, but in the UK, we do like to be different, don't we? And we even have our own way of representing a balance sheet. So we don't use assets equals liabilities plus equity. We use a slightly rearranged version. The assets less the liabilities equals the equity. It's exactly the same information, exactly the same numbers, but it's presented in a different way. And I'd just like you to contemplate which of these methods you prefer. Which method do you find the easiest to understand? And just while you're contemplating these alternatives, so either A equals L plus E or A minus L equals E, while you're contemplating, I'm going to launch another VVox poll and give you a chance to join in. So which of these do you prefer? Well, I've got a question in VVox that you can answer. So hopefully on your devices, if you bring your VVox system back to life, hopefully you can now see the question. And if you can't do this via VVox, don't worry. Either type your answer in the chat window or maybe just think about it. And there's it's not necessary for you to share your answer, of course. But it'd be great if you could. Do you have an opinion? Which version of the balance sheet relationship do you find the easiest to understand? The German version, assets equals liabilities plus equity, or the British version, assets minus liabilities equals equity. Exactly the same numbers, exactly the same information, but presented in a different way. So a few of you voted. I'll give you 3 more seconds. 3, it's anonymous. And of course, this is an opinion. You can't possibly get this wrong. I'm just interested in your feedback. So I'm going to close the poll. 3, 2, 1, last chance to vote. Okay. Well, this is interesting. Okay. A 50-50 split. I must admit, and it's probably obvious, I much prefer the German version. I find it much easier to explain the German version. What have we got? A house in Kidderminster. How did we finance what we've got? Through borrowing £47,500 from the bank and by putting £2,500 of our own equity. And I find that easier to understand, but many of you might prefer, well, half of you, by the looks of it, prefer the British version, which focuses on, I guess, what's left for the shareholders. That's often the rationale that's presented. Deducting liabilities from assets means we can show maybe clearly what the equity number is, what's the residual, what's left over for the shareholders. So thank you very much for sharing. We'll be back with VVox soon, no doubt. But what I'm going to do now is take us back to the slides. I have to flick between systems. So here we are. So that is an overview of the balance sheet or statement of financial position. And really the key to understanding that information is by understanding the fundamental relationship between the 3 items, either presented in the German way or in the way that we use in the UK. Great, okay. Now, just before we move to the P&L, the statement of profit or loss, I wonder if it might be helpful for us to think about some examples of assets and liabilities. And I've got a VVox poll, but I'm quite happy for you to also use the chat window as well, if that's convenient. So if I launch the next VVox poll, what I'm interested in, please, is you sharing as many examples of assets as you can think of. So this is a word cloud within VVox. So you can submit as many examples as you can think of. So you're not restricted to one, but you are restricted to entering a single word. So if your example has got more than one word in it, you need to put a hyphen between those words to turn it into a single submission. So can I invite you, please, to share as many examples of assets as you can think of. Let me remind you, assets are resources controlled by the business. There's a little bit more to it than that. These are resources from which we expect economic benefits to arise to the organization. So assets are useful. They have value to the organization. And I'll give you a few more seconds to share examples. And then we'll see what you've come up with. In fact, I think I can allow you to see them appearing. There you go. So you're probably familiar with these word clouds. So the most popular answer appears in the largest font. So equipment is a really popular answer. Cars, really popular answer. Unfortunately for me as an accountant, a very popular answer is employees, and I can also see people. So one of the reasons for running this exercise was to reveal to you that often, or maybe not often, in some cases, accountants recognize an asset is an asset, but they don't let you put it on the balance sheet. And let me give you a cliche that maybe helps you with this. An accountant is somebody who prefers to be absolutely wrong rather than approximately correct. People are very, very difficult to value. So we typically only record assets at cost. And because most employees were not purchased by their organization, so for example, football clubs pay for the right for Jack Grealish to appear in their team and not Aston Villa's team. Most people, there is no payment made or no significant payment made to acquire their services. So I'm afraid employees may feel like they're really important, and of course they are, to the success of an organization, but they don't appear on balance sheets. Why? Because we don't know what the number should be. Second reason, strictly speaking, organizations don't control their employees either. So I'm afraid people fail two tests. They can't be reliably measured. And secondly, they're not controlled by the organization. They can leave. They are not compelled to go to work for that organization. So, but there's some really great examples of assets here. And maybe I'll take the opportunity to classify assets as either long-term, we call those non-current assets. So assets that we expect to use for more than a year, non-current, and they can be tangible. So we've got here equipment, we've got offices, but they can also be intangible. So we've got, for example, software here. So non-current or long-term assets can be split between tangible, things that can be touched, and intangible, things that can't be touched. So thank you for sharing some really great examples of assets. So these are the resources we control. Often they're owned, but they need not be. We can control, for example, a motor vehicle through a lease arrangement, even though we don't legally own the vehicle. So those are assets. Thank you for sharing. If you have further questions, please pop them in the chat window and I'll try and keep an eye on those. What about liabilities next? So let me close that one and let's turn our attention to liabilities next. Can you think of some examples of liabilities? A liability is an obligation. When we take the photograph at the end of a month or the end of a year to draw up the balance sheet, the organization owes money. Can you provide some examples? This is harder. There aren't as many examples of liabilities, but nevertheless, you can probably think of a few. Thank you for those of you who have joined in already. Any of you who are not able to use Vivox, feel free to type some suggestions in the chat window, that's fine. And I'll give you a few more seconds. In fact, we can see them as they appear, can't we? So let's see what you've come up with. So yeah, amounts owed to suppliers in the supply chain, which could also be called payables or creditors, trade payables, bills to pay, good example, good use of the hyphen, by the way, as well. Outstanding invoices, bills to pay, we might describe those as trade payables or trade creditors, the amounts owed to suppliers for goods or services received that have not yet been paid for, but we have got the invoice. We've recorded the supplier's invoice, we just haven't paid it yet. Mortgages, loans, lease obligations, some great examples here. Thank you for sharing. A loan, so great examples. The only one that I was hoping to see that I haven't seen is my favorite word beginning with A. So a very interesting and important example of a liability is quite a strange word. You only find it associated with accounting, really, but it's a word beginning with A. Anybody use the chat window or turn the microphone on to share? What's an example of a liability that starts with the letter A? One of my favorite words in the English language, very important accounting idea. You may not have come across it, of course. You're all racking your brains to think of words beginning with A that might be relevant here. Have you heard of the word accruals or accrual? An accrual is a very special type of liability. We've received the goods or services before the year end, but we haven't recorded the supplier's invoice. So we might have been using electricity in December, but when we draw up the balance sheet, we haven't yet got the electricity company's invoice. So we estimate. And it's an example of where accountants, who I've just said prefer to avoid subjectivity, you know, they prefer to be absolutely wrong rather than approximately right. We generally don't like using judgment and subjectivity. We prefer numbers that can be relied upon, but of course accruals are estimates. Often we're estimating the amount of electricity we've used without knowing for sure. So I hope that's helpful. I spend a lot of time working with small business leaders, trying to persuade them that without adjusting for accruals, their accounts are wrong and potentially not reliable. So for me, accounting information needs to be reliable, not because the rules or the law says so, but because it gives information that might be useful for making decisions. And a lot of my work on the Goldman Sachs program is about how owner managers can perhaps improve the integrity of the accounting information that they use on a monthly basis to help them make better decisions. And adjusting for accruals is one of the important refinements we can make to make the information more useful. I'm going to pause. I've been talking a lot. Some of you have joined in. A lot of you have joined in via Vivox. Thank you. Haven't given you much chance for questions yet, so I'm going to pause for breath. Any questions so far? Anything that I've missed? Anything you'd like me to elaborate on? Silence means contentment, but please turn the microphone on and jump in. Okay, thank you for that, in which case I might take us back to the slides in a moment. Maybe I should, for completeness, highlight, just like assets get divided between long-term and short-term, so non-current assets are long-term, current assets are short-term. The same applies with liabilities. We have short-term liabilities, those due to be paid within a year, and non-current liabilities are those liabilities due to be paid in more than a year after the year end. So thank you very much for joining in on Vivox. Let's go back to the slides, if I can do that quickly. Okay, so we've concentrated so far on the balance sheet and hopefully strengthened your understanding of some of the key terminology, and in particular, your understanding of the fundamental relationship between these items. What I'd like to do next is turn our attention, however, to the P&L. Now, I expect the statement of profit or loss to be a bit more intuitive, a bit more familiar to probably all of you. But I do find in my experience that there can be some confusion regarding the way in which we measure profits. So I've got a couple of challenges for you now. One relates to the way in which we record sales revenue or income, and the next challenge relates to the way in which we measure expenses, because profit is sales revenue as measured by accountants, less expenses as measured by accountants. And I think it would be very important for any business manager to be aware of the rules of the game here, the way in which accountants measure performance. Any of you managing a budget, the same principles will apply. We don't necessarily record income just because the cash was received. We don't necessarily record expenses just because the cash was spent. So I have a question for you. And again, this exists as a Vivox poll. So I'll allow you to think about the question and choose an answer, and then we'll switch to Vivox and you can let me know what your choice is. So do you think accountants record sales revenue? Number one, when an order is received. Number two, when the goods were manufactured. Is it the date when the goods are delivered to the customer, or is it the date when the customer pays in cash? So you've got four choices, 1, 2, 3, or 4. And what I'm going to do in a moment is launch this as a Vivox activity for you to share your thoughts. So I have to switch between the systems. So I'll just share my screen again for you to join in. So is it when an order is received? Is it alternatively when the goods are manufactured? Is it when the goods are delivered to the customer, or is it when the customer pays in cash? So I've launched the VVox poll. A reminder, this is anonymous, so there's really no penalty here for guessing. So have a guess even if you're not sure, and I'll give you a few more seconds to see what you've come up with. Okay, 3, 2, 1, last chance. Okay, see what you think. So well done. The most popular answer is the correct answer. So accountants record income basically when the business has performed its obligation to its customer. So if you're a manufacturer, you deliver the goods to the customer accepts them as being what they wanted, what they ordered, then we can record the income, even if the cash hasn't yet been received, even if the cash has already been received. So if we've already received a deposit from the customer, we shouldn't be recording the income at that moment. We should be recording the income at the point at which the goods have been delivered to the customer. So for a service provider, it's the delivery of the service to the customer that allows the business to record the income, even if the cash might come 1, 2, 3 months later, or as I've already explained, even if the cash was received or part of it in advance. In which case that would be recorded as a liability to the customer. So that's how we recognize income. Well done to the 50% of you got it right. The other side of this, of course, is working out what the expenses should be, because we only have the right profit if we have not only recorded income correctly, but we need to also measure expenses correctly as well. Now, the next one, it will be quicker, perhaps, if I don't go to VVox, so I might be inviting some answers in the chat window instead. So that the other side of this is to record and measure the expenses based on the costs consumed in the period the income was earned. So just noticed my camera was at a strange angle. So I've got some examples for you to reflect on this. So an expense in accounting is a cost consumed in the process of generating income in the period. The key word here is consumed. So I want you to take these examples one by one, and for each of them, what do you think the expense is? In the year ended the 31st of December 2020. So what if we pay 6 months rent of £12,000 in advance on the 1st of November 2020? What would be the expense, please, in the chat window? How much of that has been consumed? So I'm getting you to work quite hard here, but I think in the interest of strengthening your understanding of balance sheets and now the P&L, I need you to do some of the work, because accountancy requires practice. It requires you to sort of engage with the ideas and try to do it for yourself. So what do you think? What would be, how much of that £12,000 has been consumed by the end of December? That's another way of asking the question. If you pay £12,000 for 6 months rent, how much of that has been consumed by the end of December? Excellent answer, Michael. It's £4,000, because 2 months have been consumed by the end of December, and then the other 4 months will get consumed between January and April 2021. So for all of you, do you all agree, even if you thought it might have been a different answer? Michael's got it right here, £4,000, 2 months worth has been consumed, November and December. January, February, March, April, not yet consumed, not consumed by the end of the year. So just conscious of the time, so maybe the next two I'll help you with. The second one, if we receive a telephone bill for 3 months worth of telephone services that covers the period to the end of February 2021, well, that's December, January, February, only 1 month, only £300 will have been consumed by the end of 2020. So that would be the expense. And for the third one, if we buy 10,000 units for £50,000 and sell 8,000 of them in the year, well, the amount consumed would be £40,000. So The expense is not the cost of the goods that we've bought or produced, it's the cost of the goods that were sold in the period. Again, the key word here, what's been consumed in earning income in the period. So I've got the answers to share with you. These slides, I think Vanessa's going to send out. If they're of interest, they'll be sent out to you separately. So hope that last half an hour or so has given you a bit more confidence in the balance sheet and the P&L and some of the key ideas that sit behind those statements. And if you feel like you need more, well, first of all, that's realistic. Half an hour is not enough for this subject. And I'm hoping some of you might be inspired to download this Count FIFI game. FIFI stands for Financial Education for Future Entrepreneurs. It was a project that we led at Aston Business School, and the main output from that project was this digital game. You can download it from the App Store or Google Play, and you are taking the role of an entrepreneur, and hopefully you progress through the game by developing your accounting and finance literacy. So it's been a great pleasure to work with you. I know time was short, and I think time is now up. Oh, Jackie had a question. Can I repeat number 2? I'm happy to go back if we've got time to do so, Vanessa. I hadn't spotted Jackie's question till now. Until Vanessa stops me, I'll thank you, Vanessa. So the second one, if I just remind you the question without the answer distracting you. If you've received a telephone bill that covers a 3-month period to the end of February 2021, do you agree the 3 months that we're talking about are December 2020, January 2021, and February 2021? Only one of those months is relevant for the financial year ended the 31st of December 2020. The January and February telephone services costs belong in the 2021 financial statements, not the 2020 financial statements. So Jackie, hoping this is helpful. Only 1 month or a third of that bill is consumed by the end of December 2020. Thank you for your question. Sorry for not spotting that until a moment ago. So where was I? I was promoting this free app. There's no cost here. Please download it, and good luck with it. We continue to work on this app, so we are planning to relaunch it, rebrand it as simply The Count, but that's not quite ready. So would be delighted to get feedback from any of you after trying out the game if you think it could be improved. So thank you everyone for spending part of your lunchtime today with me. Hope it's been useful, hope it's been interesting.